Welcome to the channel. We're continuing in the series on Optionstrat. In the last episode, we talked about the long call, which is a bullish options trading strategy that anticipates the rise in the price of a stock and how you can make money from it. And in that video, we looked at how you could potentially make more returns from trading a long call compared to buying and selling the stock outright. We will leave a link to that video in the comment section. You can go and check it out before you continue in this video. In today's episode, we're going to talk about the long put options trading strategy, which is the reverse of the long call options trading strategy. And in this trading strategy, you are bearish on the underlying asset. That means you anticipate the price of the underlying asset to go down. And you can also use this as a powerful alternative to shorting the stock. All right, let's get it. All right, so there are two strategies you can deploy when you anticipate the price of the underlying asset to go down. The first one is to buy a long put. And in this instance, what happens is you buy the long put, you don't intend to hold the long put forever. You anticipate that as the price of the underlying asset decreases, the value of the long put increases. And at some point before the expiration of the put contract, you can sell your long put for a premium and cash out. With short selling, however, what you do is you borrow, in quotes, the stock from the market and you sell them to another buyer. And the anticipation here is that the price of the underlying asset will be reduced when it's time for you to buy them so that you can return what you borrowed from the market. And herein lies the potential for the profit. The difference between the long put and the short sale is that with the long put, the maximum amount you can lose is the amount you paid to buy the put. And the worst case scenario here is that the price of the underlying asset does not drop to that amount and the contract expires worthless and you cannot sell the put for a profit. Whereas with the short sale, if the price of the underlying asset goes down to zero, you could lose a lot more than you anticipated. And so the long put provides a better risk management strategy for cashing in on a stock value that is set to decline. Let's take a look at how you can find stocks whose values are in decline mode or that you can be bearish on. If you've been on this channel for long, you will recognize that one of our favorite websites for finding stocks to trade on is finviz.com. And so you go to finviz.com, you click on the screener tab, and you select the all sub tab. Of course, we want to look for stocks that we can trade options on. So in the drop down menu for options short, we click on optionable. And the idea here is to look for bearish trending stocks. And so you click on the signal drop down, and what you want to do is select the channel down option. And you can see when you look at the charts that a lot of the stocks that are highlighted here are trending down. So let's take a look at one of them, the VXX, which is the iPath Series B S&P 500. Now, if we go to Optionstrat and we type VXX, for the December 16 expiration, you can buy the 1450 put, and the expectation here is that, as we see with VXX, seems to be dropping because you've had lower highs and lower lows. That means this seems to be continuing with its bearish direction, and it doesn't look like it's about to turn around soon. So going back to Optionstrat, the indication here is if we buy the 1450 put, we will pay $68, and that is the maximum amount we can lose, but there is a maximum profit potential of 1,382. And if we look at the chart range, what you will see is that the value of the profit increases as the price drops, but also as you move towards the expiration date of the contract. And so all you need to anticipate is less than a dollar drop in the price of the underlying asset. Because if you look at today being December 12, 2022, VXX is trading at $14.39. By the end of the contract, if the price stays round about $13.50, you should be able to sell your long put option back and make a $32 profit, which will be close to 50% returns on the amount that you paid for the long put when you started the contract. So we see here that the long put options trading strategy allows us to be able to make money when we anticipate that the price of the underlying asset is about to decrease or to continue on a downward trend. And this gives us action. And this shows the value of options. With a typical scenario of buying and selling shares, you really can't make money when the price of the underlying asset is going down. You only make money if the price of the underlying asset increases so that you anticipate a sale at a higher price than what you bought. But with the long put and other options trading strategies, you can actually create a potential for revenue generation, whether the price is going up or going down or going sideways. And we will see a lot of these strategies as we go along in this series that we talk about Optionstrat. If you want to sign up for an Optionstrat account, check out the link in the comment section. And in the next episode, we will look at the covered call strategy, which is one of my favorite strategies for options trades, and how you can use covered calls as a tool to generate income for yourself. Thanks for stopping by. As always, hit that subscribe button if you haven't done so already. Hit the notification icon so you get to see new content as soon as they're uploaded to the channel. If you like what you've heard, hit the like button. Share this with people on your social feed and check us out on Twitter and Instagram.